Thank you for joining the Nedgroup Investments Global Flexible Fund conference call. I have some prepared remarks, and then I'm going to turn it to Brian Selmo to walk through a couple of investments in the fund, and then we'll turn it back to me for a little bit more of a global view of how we see the world. The fund has an unusual ability to invest broadly in the service of the fund's goal to provide an equity-like return over the long term with less risk in the market while avoiding a permanent impairment of capital. It can put money into equities at various market caps around the globe, high yield and distressed credits. Simply having an impressive collection of tools in our belt, however, doesn't mean they're consistently in use. If we moved into a newly constructed home, we'd not likely remodel the kitchen. Today, the equity and credit markets are like new homes, offering us little opportunity to use our tools. Where you wield a hammer, everything can't be a nail. Since 2009, however, we have been living through the longest post-World War II bull market, now 124 months and counting. For the first time in my 3-decade professional career, I haven't seen a bear market, with stocks declining more than 20%. We have no idea when there might be a market reversal, but it would most likely entail some combination of higher interest rates and/or weak economy. With the U.S. Central Bank's 2 recent rate cuts, one of which just yesterday, and an economy that's still bumping along, it might be more of the same for a while, or not. As I mentioned, not only have recent market returns been unusually robust, but FPA's value style of investing has also been out of favor. This won't likely last forever. There should eventually be a market correction. In those periods where value outperforms growth, the right column, FPA's contrarian value strategy has outperformed 90% of the time, adding more than 800 basis points of annualized performance. This compares to the much lower 265 basis points of underperformance versus the S&P 500 when growth is outperforming, the left column. This chart shows how we can make up quarters and even years of underperformance in short order. That is usually the case when markets correct and we are able to put capital to work, as we have done for the past quarter century. And so for some time, the fund's portfolio composition, and by extension its performance, has regrettably appeared relatively more ordinary than its entire history would otherwise suggest. That will continue to be the case until such point in time when we can pull tools from our belt to create real value. The stock market currently still offers us occasional opportunities to own good businesses and other misunderstood assets priced to offer attractive prospective returns with limited downside. Still, we are presently in the 11th year of the longest-running U.S. bull market in modern history, and it is challenging to assemble a fully invested portfolio that meets our risk-reward hurdles. Yet the Global Flexible Fund returns have continued to deliver equity rates of return while assuming less risk than the stock market. The fund's mark-to-market losses of Q4 2018 have been entirely reversed through the second quarter of 2019. The fund's cumulative 2-quarter return since the end of Q3 2018 is slightly better than the broad U.S. market and well ahead of the global market average. Here we are more than halfway through the year, and growth continues to trounce value, and the U.S. stock market continues to beat most foreign stock markets. As can be seen in this chart, the growth indices are ahead of the domestic and world value indices by as much as almost 700 basis points and almost 1,000 basis points ahead of the emerging markets index. The Nedgroup Contrarian Value Equity Fund, a long-only equity fund investing in companies with market caps over $10 billion, performed well in the first half. It returned 19.7%, ahead of most of the major indices and about as much as the growth subsegments, despite the fund's value focus. Despite the aforementioned decade-long headwind of value underperforming growth, the FPA Contrarian Value Strategy's equities have outperformed the broad market averages since we started keeping track in 2007, best in the S&P by about 1.8% per year and the MSCI World by 4.8% annualized. In part, because of the recent greater divergence of growth and value, the fund stocks underperformed the broader benchmarks in 2017 and 18, although that has reversed thus far in 2019. Long equities held by the fund returned more than 4% better than the MSCI World in the first half, and about 2.5 points better than the S&P 500. The fund returned 13.7% in the first half, exceeding its global flexible benchmark. The fund generated 80% and 69% of the MSCI World S&P 500 returns, respectively, with just about 2/3 of its capital at risk. The fund benefited from broad-based performance in the first half, with only a few of its investments meaningfully detracting from the year-to-date return. But rather than a cause for celebration, regard such favorable breadth as more a reflection of this bull market than a credit to our competence as portfolio managers. There was little in the way of news that drove individual contributors or detractors in the fund. While most of the tools we use remain in our belt, we're putting a few to work. For example, as of the second quarter, the fund's Puerto Rican municipal bond position has grown to be a larger holding, making up a majority of our unusually small credit allocation, 2.1% out of 2.6%. We had previously never owned municipal bonds. As mentioned, our credit allocation is far below our historical allocation because of subpar yields, mediocre credit spreads, and unattractive levels of leverage and poor covenants. We also recently purchased a Japanese company for the first time in the fund. You should generally expect that the fund's equity exposure will move inversely to valuations, all else equal. We tend to buy into weakness and sell into strength. This is supported by recent portfolio action as depicted in this chart of the trailing 4 quarters. While equity risk exposure increased into market weakness in late 2018, we have been sellers more recently as stock prices have rebounded faster than fundamental growth, thereby reducing the risk rewards of various positions. International stocks have underperformed their U.S. counterparts by a third in the last couple of years. This has resulted in more attractive opportunities overseas. And this has caused Nedgroup's global flexible funds foreign exposure to increase from 24% in Q4 2017 to 30.8% in Q2 2019. And it had dropped down into the lower 20s in the 2018 period. So this is a new high for foreign in the fund today. We have included the fund's holdings as of June 30 for you to review at your leisure. I'm going to turn it over to Brian Selmo to review a couple of the fund's investments. Our hope is that by discussing investment examples that our shareholders and partners gain a better understanding of how we execute on our strategy.
Thanks, Stephen. I'm going to share 2 investment examples of current positions in the fund. They represent different types of investments that we make. One, Jefferies, the first example being a classic discount to net asset value and a resource conversion opportunity. The second, Comcast, is a high-quality franchise business with a growing underlying value or business proposition. So first, Jefferies. What is Jefferies? It is a collection of businesses that operate in the financial sector, where you see on the left-hand box, if you're looking at the page, investment banking, capital markets, and asset management. These are wholly owned operating businesses. They include the Jefferies Investment Bank, which is both M&A advisory, capital light activities, as well as a capital markets business. Lucadia, which is a commercial mortgage-backed security origination and servicing business, largely now transitioned to a fairly asset-light servicing portfolio. And Lucadia Asset Management, which I think everyone on the call will be familiar with, is a alternative investment asset manager. That comprises the box on the left, which we would expect to be long-term holdings of Jefferies and to compete and provide attractive 10% plus returns on tangible common equity. The other portion of the business in the box on the right is a merchant banking portfolio, which is a collection of partially and wholly owned businesses ranging from energy, telecom, to meat processing. This is a portfolio that is made and investments that are made on an opportunistic value approach. The management team and directors at Jefferies have an outstanding long-term record of successfully making merchant banking acquisitions. Currently, as you can see on the top, the business trades at about 80% of tangible book value. And based on our estimations, we think that the merchant banking portfolio could be readily sold at a meaningful 20 to 30% premium to that stated tangible book value. So this is a situation of an investment where the business has performed quite well but the stock really hasn't moved very much since the time we bought it. So in the last year and a half, almost year and 3/4, tangible book value per share has increased by 21%. We think that intrinsic value has increased by even more than that, with improvements in the operating position and competitive position of the investment bank. The management team, who owns 16% of the shares outstanding, have repurchased approximately 20% of the shares outstanding at a meaningful discount to tangible book value, hence increasing our, as ongoing owners, proportionate share of what we think is a discounted franchise. We would expect management to continue to return capital to shareholders in the form of buybacks or recently announced distributions from the merchant banking portfolio. So earlier this week, the company announced that they would be returning shares of a publicly traded company that they hold in the merchant banking portfolio, immediately closing the discount between where those shares trade and the value realized by outside shareholders. As you can see, management and the board owns a significant position in the company. We believe they are well aligned with us and will continue to take steps to increase the intrinsic value per share to shareholders, as well as working to close the discount, which is a stated long-term goal of the company. The next company I'd like to talk about is Comcast. Comcast is a leading global media company with platforms primarily in the United States, but with the recently acquired Sky franchise, giving the company a strong direct relationship with customers in Europe and India. The economics of Comcast are primarily in the U.S. cable business, representing about 65 to 70% of the company's free cash flow. When you hear cable, you may be thinking about TV, but in reality, the cable business economically is dominated by broadband connections. This is providing a high-speed data internet pipe to homes and businesses across the United States. Comcast is the largest provider of this service in the United States, and this is a business that has grown well over the last number of years and that we would expect to continue to grow well in the future on a combination of taking share and customers from other incumbents, primarily slower services such as DSL or more expensive to deploy services such as fiber to the home. This positioned Comcast being the lowest cost provider of a necessary and superior service, namely high-speed internet connection, has allowed the company to grow both price and users fairly consistently over the last number of years. Given that we think that broadband access is a commercial necessity for homes and businesses going forward, we expect this business to continue to grow smartly over the foreseeable future. The other part of Comcast is the Sky NBC Universal business. And this is a business that has a more uncertain future, but whose value we believe is underpinned by various tangible assets in the form of theme parks at Universal, buildings at NBC, if you think about the lots, or if you think about One Rock in New York, and then also over-the-air spectrum rights in the TV stations. The Sky business has already meaningfully moved towards an over-the-top self-produced content with a direct relationship and channels that you are probably familiar with in Europe and India. So while less certain in terms of the outlook or in terms of the picture of what the industry will look like over time, we think that Sky NBC Universal is well positioned to compete in the over-the-top future. They will be offering an over-the-top product at some point between now and probably the end of the first quarter next year. Now, for all of this, the stock trades at less than 14 times free cash flow. As you can see on the right, the company has meaningfully increased the dividends over time. The company has a strong history of returning capital to shareholders. The CEO's family has more than $1 billion position in the stock. something you've heard maybe now in both situations is that we like to be aligned with management teams that have meaningful positions in the underlying businesses that they operate. I will turn it back over to Stephen.
Thank you, Brian. I'd like to spend our last bit of time together discussing the current environment. Global risk assets generally have elevated valuations, as I'm sure most everyone is familiar. Looking at this series of charts on this page, you can see various asset classes have all types of high valuations being reached. On the upper left, you can see the stock market as a percent of their respective economies. The U.S. is at an all-time high, and the world, ex-U.S., is about its all-time high. Global private equity multiples in the lower left, median multiples, are about their all-time highs. The yield to maturity in the upper right, we've inverted this to show this upward sloping to the right, higher valuations. But the yield to maturity in U.S. and European high yield is at an all-time low. U.S. real estate cap rates of all property types are also at an all-time low. No great surprise given the low level of interest rates. Unusually, both risk-on and risk-off trades are working right now, allowing bulls and bears to win concurrently. Most global stock markets are trading at or near all-time highs, and gold and long-term U.S. Treasury bonds have also rallied. Thus, we have opposing and thriving in the same market. Interest rates have helped drive stock market returns over the past few decades, and now, while only marginally higher than 1,000-year recorded plus lows, rates are again expected to remain low and perhaps sink even more for even longer. Low interest rates make stocks more valuable. They make all cash flowing assets more valuable. We use the dividend discount model here, or DDM, as a simple proxy for valuing businesses to illustrate that principle. In the dividend discount model formula, P is the fair price of a particular stock, D is the expected annual dividend, R is its discount rate, and G is its growth rate. Assume that the value of a business is equal to the sum of the cash flows received by the shareholder over time. Of course, many companies reinvest that free cash flow and pay no dividend. We assume dividends and cash flow are interchangeable for this simple example. We will assume a dividend growth rate of 5% and set the initial dividend at $1 a share and leave each of these variables constant as to isolate the effect of interest rates. We will assign a discount rate based on a U.S. government bond plus an equity risk premium. In this example, we use the rate of the 10-year U.S. Treasury note in 2007, which was 5%, and the same note in 2019 when it was 2%. That was at the end of June, so obviously dropped lower since. And then we add a 5% risk premium, which gives us a discount rate of 10% and 7% respectively. In this case, the value of a business in 2019 that looks the same as one in 2007 would be worth 2.5 times as much, thanks to a discount rate that is 30% lower. In other words, low interest rates have added 7.9% to the return of the market since 2007, all else being equal. That is the rate of return from $20 to $50 over 12 years. That's virtually equal to the U.S. stock market return. With the 10-year Treasury yielding a lowly 1.67% today, and the ravages of inflation having reduced purchasing power, a retired person investing today is left with just 3 choices: curtail lifestyle, spend principal, or take on more risk. As creatures of habit, changing how we live is difficult, particularly if it means consuming less. Watching your nest egg shrink is also discomforting unless your corpus is unusually large or you are older so that it matters less, assuming you don't plan to leave much to your heirs. So it's not surprising that most people select the third option and assume more risk, perhaps without even realizing they have added risk to their portfolio. Eventually, they may find their way to stocks that pay no dividend at all. This has led the average household to have 44% invested in common stocks, the second highest level in the past 18 years, the graph on the left. The larger equity ownership generally suggests lower future stock market returns. Household ownership of equities, currently at that 40% level, falls into the highest quintile and suggests dismal prospective returns, as reflected in the chart on the far right, particularly the bar on that chart on the far right. Low volatility is frequently a byproduct of investor complacency. We, on the other hand, gravitate towards volatility. High vol gave us the opportunity to put capital to work in 2018. Volatility has declined significantly since then, and it's not just equity volatility. As you can see on this slide, in addition, interest rate, commodity, and currency volatility are all well below average, and for the most part, about as low as we have ever witnessed. As we said, at some point, things change. Vol will pick up, we will have a recession, again one day, and whenever it happens, it will end the longest U.S. economic expansion on record. Meanwhile, we will only invest your capital when the risk reward is attractive. We won't assume a necessary risk to reach for return. We won't, for example, be buying the low-yielding, high-yield bonds in the U.S. and overseas. We cannot even begin to make sense of the 14 European companies that have negative yielding BBB bonds, one notch above junk, where the investor has to pay to own them over the life of their maturity. This is a June 30 chart, and there's now more than 14 EU companies with negative yielding BBB bonds. The skewed appreciation of risk shows up elsewhere. Take the 5-year Greek government bond that currently yields 0.69%, less than the 1.64% for the equivalent maturity U.S. government bond. This slide shows the respective yields at the end of June, and they've obviously declined since then. Some investors are surprisingly willing to take a 95 basis point lower yield for what is arguably a weaker Greek credit today. This is a far cry from a couple of years ago when Greek sovereigns traded with an almost 3% risk premium to U.S. treasuries. We will continue to seek to avoid participating in the irrational and focus on seeking the best risk rewards for your portfolio. We'd like to thank our listeners for tuning in today, and we deeply value your continued support. With that, we will turn it back over to Nedgroup. Thank you.
Thanks very much, Steve and Brian. We really appreciate your time. Steve, you spoke a fair amount about your position in AIG when you visited South Africa earlier this year. That position has run quite hard year to date, up sort of 40 to 50% to the latest numbers. Is there still significant upside for you to obtain from that position? Are you still comfortable with it being your number one equity holding in the fund?
Yeah, so this is Brian. I'm happy to talk about AIG. I think there are a few things. One, let me just level set everyone on what sort of the position is in AIG, the thesis, and then sort of how we've moved the position around the last 12 months. And then I'll get a little bit to your question. So AIG is a international insurance company I think everyone's familiar with, got in trouble during the financial crisis. They brought in a new management team. This is probably going on 2.5 years now, led by Brian Duperrault, and who's really a kind of hero in the insurance business. He's was a big player at AIG when it was world-class back in the 80s. He went and started ACE, which became Chubb and is kind of the world-class of the commercial P&C business now. And then he turned around Marsh Mac after some of the, contract rigging issues that they had following Elliott Spitzer. So he's really got a track record of demonstrated success. He's got a business partner, Peter Zaffino, that he brought over with him. And the situation at AIG is that they had a large traditional commercial P&C business that has just really been undermanaged for a number of years, following the distractions of the crisis. And so the company, while it had a stable capital base, wasn't earning a very good return on that capital. And so the excitement was that they would be able to improve those operations. And really the way you're going to see that in an insurance operation is through the underwriting profitability. So meaning that they're making money on the contracts that they write, not just on the investing side. So after, rehabilitating, let's say, the team, adding staff, AIG's stock got beat up quite a bit late last year. From our perspective, for really no good reason. If you would have talked to the management team or listened to them at conferences, you would have heard them say that everything was on track. It just sort of takes a little bit of time to turn over a insurance book. So we added fairly meaningfully to the stock last year. This year, in both the first and second quarters now, the company has started to demonstrate improved results in the property and casualty business. And so that's going to underpin more consistent earnings power at the firm, and that's resulted in a bit higher valuation. So with that higher valuation, we have trimmed the position and sort of kept it at about the same size as it was, maybe a little bit smaller at the end of last year. That's, as you mentioned, on the back of the stock being up 50% or so. So it's, we've net reduced the amount of shares we have. In terms of going forward, I think we're still early in the turnaround of the business. And so there's two things that need to happen. One, they need to demonstrate underwriting excellence, which I think they're now underway. And then two, they need to demonstrate operating excellence. And operating excellence would be things like the efficiency ratio or the cost base of the business. So it had not been call it well integrated from a technology perspective. That's still a big opportunity. They're calling this AIG 200. And that's probably a 2 or 3 year effort. Long term, though, we think that AIG can perform near the top of the industry. So what would that mean in terms of valuation? So currently the stock trades at about 85% of tangible book. I'm going to run through this maybe quickly. If you want to redirect, I'll go over it. There's a bit of that book that is less productive. It's in the form of deferred tax assets and then legacy runoff portfolios. So we think that part of the book is only worth about 50 cents on the dollar. And so that takes about 20 points of book value down to about 10. And so we're left with what we would call adjusted book value, somewhere in the mid-60s. And there we think the company trades about 90% of that. Now, long term, we can look at where other leading property casualty companies, and then they also have a retirement and life business, combined would trade. They would trade somewhere between 1.25 and 1.5 times that tangible book. So that kind of puts an idea around what the upside would be when the turnaround is fully realized. So that would be somewhere around, call it $80 to $100. Now, in the meantime, we would expect the company to generate earnings of somewhere between $4 and $6 a share, going up over time. So if you think out 3 years when we would expect the turnaround to be well demonstrated to the market, yeah, we think the upside over that time is somewhere, call it between $90 and $120 a share. Now that requires execution, obviously. Some of the easiest bits of this, right, just convincing people that they have a viable P&C business is over. And so that's why, on the one hand, we continue to hold the stock because we do think there is a multi-year opportunity. But two, why we control the sort of sizing of it and bring that down as the payoff to that successful outcome is less than it was when the stock was at 36 or 38 or wherever it ended the year.
Steve, you mentioned new Japan stocks in the portfolio. I believe that's Nexon and Olympus. Would you just touch briefly on the rationale for including them?
Sure. This is Brian. Olympus is in a number of different businesses. You may know it from the cameras back in the day, and shamefully they still make those cameras and they're not able to sell them, but they spend a lot of money making them. But Olympus, the real attraction to it is a fewfold. They're the world's leader in endoscope products. It's a medical device that's used, for less invasive surgeries and colonoscopies primarily. So that's a business where they have, somewhere, depending on the specialty, between 60 and 80% share. They have such dominant share because the teaching hospitals of the world are seeded with these devices, and this is where the practitioners, or the devices that the practitioners learn to work on, and so then they're kind of requested in the hospital settings. So it's a very strong business model. The margins in that business would be north of 30%. They have I'll call it middling med tech business of other sort of equipment that would go into hospitals. That's more of like a 10-15% margin business. They have I mentioned the Olympus camera business, which is a unmitigated disaster, loses a bunch of money. And then the last business is like industrial supplies for lab equipment. It's indifferent. So, and then being a Japanese company has a strong balance sheet. So what's attractive about this is that we think that the sort of gem of the endoscope business is being hidden by the losses in the camera business. And we think that there's no reason for them to be in that business. Now, that's probably a story that you could tell often in Japan, where you've got a bit of a bloated overhead, low return on capital focus from the management team, and some legacy businesses that don't make sense to be in. What's interesting about Olympus is that recently they put 2 people on the board from a firm called ValueAct in San Francisco. ValueAct are well-known constructive activists, so their maybe greatest claim to fame would be that they were responsible for getting Steve Ballmer out of Microsoft. And then you'll notice that Microsoft, which was probably had a number of gems within it, but were maybe hidden by some of Ballmer's initiatives. And I think the stock's gone up 3 times or something since that happened, 4 times, Steve's telling me. But that was a large holding for us, and something where we watched what ValueAct did in a constructive manner, friendly. You wouldn't have read any headlines about them screaming or yelling at anyone. But we're really able to shepherd a great franchise to a better future. And so we think there are elements of that. I'm not suggesting it'll be as successful as Microsoft, but
there's no guarantee. They have 2 seats on the board. It's still a minority, position on the board. And Japan has been notoriously, unkind to or unreceptive, I should say, to the meddlings of the Gaijin investor. So we hope that in this case
they were invited on by a new CEO who, based on conversations with his predecessor, is very focused on the same sort of issues that ValueAct is, and so we would view their involvement as being less hostile and more of a concerted effort or partnership with the new management team. So that's all the hope. So the hope is that they will get out of the bad businesses, refocus on the good businesses, demonstrate those franchises, and let the growth of those businesses be reflected in the market over time.